and this time we're going to be discussing the tanker shipping markets. I see from the panel composition there's going to be a main focus most likely on the product side, but I would argue they're all interconnected. So this is highly relevant for whatever tankers you might be considering and looking at. My name is Jorgen Lian. I am the head of shipping equity research at the DNB Markets out of Oslo. And on me on this panel today, I am lucky to be joined by the CEO of Ardmore Shipping, Gernot Ruppelt. We have the CEO of DIS.MI as well, Carlos Balestra de Mottola. And we have James Doyle representing Scorpio Tankers. And on the end, as in the dry bulk panel, we have Ted Petrone, Vice Chairman of Navios Maritime Partners. So thank you all for being here. We'll kick it off a bit. My perception, having spoken to quite a few investors recently, and there is a lot of focus on tankers, I would say the interest might have tapered off a bit. It's not maybe a surprise considering how the markets have developed over the past months. But then I turn the question to you. Based on the seasonal dip and everything that's been happening, what's your take on the attention that you are seeing from investors right now? And I can start with you, Gernot.
Yeah, thank you, Jorgen. To your point, seasonality is playing out, and this is sort of the time of the year where we're seeing this more than usual. Hard to predict the future, but if you let just the past guide your views of the future and you look at the data, typically it's in November that you really see the market step up, on average sort of 30 to 35%, and then you see another step up in December. If you look at freight derivatives, they're in contango. We see charterers out there looking for period deals around 6 months. All these things seem to be indicative of a constructive and interesting freight environment as we head into the winter. I think maybe just taking a step back, if we look at equity markets in general beyond shipping, it feels like we've been in this interesting phase of really extreme sentiment. On one hand, economy is overheating. American consumer, we have inflation. Inflation is back. And then on the other extreme, you would have views that there's cracks in the economy and, maybe a recession is upon us. And we have been kind of shifting between those two very extreme views. And I guess I would caution that we not fall into the same mind trap, where it's either just, extreme new era type of narrative around, super cycles. And then on the other extreme, that people get really anxious if we see that, freight markets or spot markets in particular don't only move up, they will also move down, and they just tend to do that this time of the year. So seasonality is playing out. It is playing out around a very, very high baseline. For us as Ardmore, we are on a path to a break-even of roughly $11,500 a day. So for us, this is still incredible returns, and if anything, maybe opens the door to some opportunity.
Okay, thank you. And I agree, looking historically, things still look good. But the appreciation of the assets and the equities have followed, so I guess the expectation hurdle has also been raised. Carlos, what's your view on the investor perception right now of investing in tanker shipping?
I agree. There was some weakness, relative weakness in the freight markets this summer. And of course also in the share prices of most listed product tanker players, including ourselves. Shares are down 25% since the beginning of July. Traded volumes also are down, but that is quite normal over the summer, and it doesn't affect only shipping. Coincidentally, last year we were very active over the summer with buybacks because we felt our shares were very undervalued, and the same happened this year again. So it's not surprising to some extent that there has been this correction. I met recently an investor who says he trades around that. I mean, he's always looking for this summer weakness to go into the market, and he plays this volatility which we have, natural volatility in our share price, because of seasonal weakness. I would say that this summer we had a bit more than the normal seasonal weakness, because I think we had such underlying strength in the market in the first half of the year that I actually thought we were going to have a very strong summer. But we had an exceptional circumstance, which was the cleanups of crude tankers, which contributed to this weakness. I think that was the main factor, more than the usual summer lull that we would usually experience.
Okay. And on that, if we continue then with James, especially the swing tonnage has been an item of discussion recently in product tankers. Is that still at play, or are we now getting out of this, in your opinion?
So we're starting to see vessels get out of it. We've been tracking the V and Suezmax vessels that were carrying clean product, and the majority of them are going back to the dirty trade. Spreads have narrowed. The underlying crude market looks quite compelling, and we think that that's probably the first step here, in addition to the seasonality, where we're going to see the improvement in rates. So rates, in our view, have bottomed out. We're going to see refinery maintenance end. We're going to see LR2s benefit from not having the cannibalization of the crude tankers. And if you look, it was something like maybe 80 LR2 cargoes over a 4-month period went on Suezmax and VLCC equivalents. So about 20 a month we're going to get back here, and we think that's going to be very constructive for products over the next couple weeks to months.
And then over to you, Ted.
Yeah, listen, this is great going at the end. I just say ditto to everybody else. I think they've laid it out. I just think the clean issue, the swing tankers, the research we've done was that, let's say, Q3 of last year, I think there was something like 30, 35 vessels uncoated that took clean product, CCP. This year it's been in the 50s. So a better crude market actually helps the CCP market. You know, the investor is right. There's a lot of seasonality here. There's cyclicality. I think they continue to look at the spot rates and stop, and not looking at improving balance sheets going forward. If you want my elevator speech, it's higher for longer. I mean, we're still getting, we do time charters, short to medium to long term. You've heard that from the last panel. They've been knocking on our door for a couple of years now, and they're still continuing to look, because especially on the Vs and the crude side, I don't see how you're going to replace the Vs going forward. Now, that differential between the Vs and the Suez and the Afras has been a little bit out of whack because of the sanctions, where the Vs haven't performed to the normal ratio between them, but I think that will certainly clear out. And I think on the product side too, I think 10% order book, but 10% is over 20 years of age. And I think as you get past the seasonality, right, in the Middle East, the Saudis have stopped burning the crude for their air conditioning. I think you'll see more demand coming out of the East, and all the supplies coming out of the West. It's amazing what's happening, dry or wet. All the discoveries in the West, and all the demand growth, sometimes not so great, is in the East. So you heard me before, ton miles on dry, and I think it's ton miles on the tanker side too. That's a big factor.
Well, you have exposure across tankers in both crude and product, so I guess you're unbiased. But if I turn that question to let's say you Carlos, you mentioned the swing tonnage, right? Does that mean that stronger crude markets are really a prerequisite to get things really going again in the product tanker market? And on the back of that, where should we be exposed, in crude or in product?
I wouldn't have answered so positively to this question at the beginning of this year. I thought there was a correlation, and there are natural linkages between the two sectors, mostly through the LR2 segment. But what we saw this summer is really exceptional. We had on long-haul voyages, 13% of refined products was transported by non-coated tankers, and that's the highest percentage ever, at least as long as the time series I have access to, which goes back to the early 2000s. So we need, I believe, a strong crude market to support the product tanker markets. Otherwise, we might see what we saw this summer again next year. I don't think this will be an issue for the coming months in the winter market. I think this activity will stop or will reduce substantially. But in that respect, I'm quite positive because I think the crude markets have very positive fundamentals going forward. Very limited fleet growth next year. Only 5 VLCCs expected to be delivered next year. I believe 28 Suezmaxes and 9 Aframaxes. So that would equate to a fleet growth, even with minimal demolition, of below 1% probably. And that should be very supportive also because on the supply side, irrespective of what OPEC decides to do, and there is speculation that they might unwind some of their cuts from December this year, there is going to be quite a substantial growth in oil supply next year coming from non-OPEC countries, 1.5 million barrels per day, coming from the US, Brazil, Canada, Guyana. So that in itself would probably create an oversupplied oil market. And would drive potentially ton miles. And if OPEC decides to unwind cuts, we could really be in an extremely oversupplied market, a market which could potentially even go in contango. And we have experienced that in the past, in 2015 and in 2020, and that resulted in a very strong markets generally for both crude and product tankers. If that happens in today's environment, where the market is already very tight, then really, I don't know what the ceiling could be for the rates, but we could really be into a spectacular market.
There is no ceiling to shipping rates. Isn't that the secret sauce?
Yeah, possibly.
Okay, but not directed to anyone in particular. But since I also get a lot of questions from the investors' side. What's happening in the crude tanker market with the VLCC rates now dipping a bit again and easing off in that period when you should have seen seasonality start to kick in? To whoever wants to answer, what's the trigger we're waiting for? What should we look out for as an investor in tankers then to get things going? And I don't know who wants to take that. I can start with Ted, since
I think as the Northern Hemisphere cools down, you're seeing stocking that's going to start soon on the Vs and on the product side. It's a normal course of events. I think the Vs, I think there's been some softness, and I think it's a lot of sentiment. We have had not bad news, but people are expecting better news out of China in terms of their creating liquidity and cutting rates. There's no actual numbers coming out. So I think the market got overexcited a few weeks ago, and now it's a bit, I would say it was overbought. Now it's oversold at this point. If I was a charterer, I'd be taking ships for period. I know our phones are more calls coming in than going out. If I could take a ship for a couple of years, I could probably get it at $3,000 a day less than I could a little while ago. That's $1 million a year. I think buying on the dips, now it may not be the absolute bottom, but we're going into Q4 and Q1, which is historically the high numbers, rates for tankers on both sides. I think everything's flashing green. I know everybody gets depressed every once in a while, but this is a volatile and seasonal market.
You agree to that, Gernot?
I just want to maybe add to that. We're seeing, of course, a bit of a drop in oil prices at the moment, and I think that's always very interesting to take stock of. OPEC Plus is expected to increase production, and generally that, of course, helps prices, find a lower trajectory. And for us, that's of course very interesting because immediately that supports refining margins. Refining margins will widen. For us, first and foremost, our cost goes down. Our biggest cost is the cost of fuel, and of course, there's a high correlation between the price of bunkers and the price of oil. And just in general, when you see oil markets tilt into a contango, you really get this trading activity where long-haul trades start to kick off. It's advantageous to keep your barrels on the water for a longer time. And as we've seen at many times, when you see a dip in oil prices, that actually really drives incremental ton-mile demand. I think also adding here, at a time when there is uncertainty and when there is volatility, the value of optionality goes up. And what gives you that option value, product parcels are traded at 300,000 barrels a day. That's at 300,000 barrels per stem, and that's very much the MR. And I think what we've seen happen on crude tankers cleaning up for clean markets, that was very much at a point in time. And speaking to some of our trading partners in the East, one thing, of course, is the differential in freight between clean and crude markets, but you're really putting a lot of product at the same time into any market. You're kind of oversaturating a market, and very quickly that arbitrage closes. So I wouldn't necessarily overemphasize what happened there this summer with regard to crude tankers finding their way into clean trades. It is, a lot of stars have to align for that to work and make sense.
Okay. And then, so the weakness that we've seen this summer, it has been there, a bit of a surprise, I must say, even to ourselves. But the importance of the Red Sea and the geopolitical disruptions in tankers has been very large, and it's been an important driver driving up ton-mile demand and tightening the markets. So the big question I guess everyone is asking, not that people necessarily think it will reverse anytime soon, but where would we be hadn't it been for the disruptive events that we've seen over the past couple of years? I'll leave that to you, James.
Sure. So I think actually product tanker rates would be lower, but equity prices would be higher.
The last part, I didn't catch that.
I think that product tanker rates would be lower without the Red Sea crisis, but equity prices for product tanker companies would be higher.
Oh, why do you say that?
Well, I think everybody is so focused on the Red Sea crisis that they've missed the strong underlying supply-demand scenario that's created this rate environment. So if you think about the product tanker market, three things are going on. One, supply has been below demand pretty consistently for the last few years. The second part is the refinery changes that have happened over the last 10 years are having a meaningful impact on ton miles. And the third is that geopolitical events have exacerbated 1 and 2. Now, everybody is so caught up in the Middle East crisis because it has had a large impact on rates that they've missed what I think is probably the most important part is these shipping companies' balance sheets are really, really strong. And, we've been able to sell ships at prices above what we purchased them new for 10 years ago, buy back stock, lower our costs substantially from $19,000 a day to $12,500. And if you look at where equities are being priced, you're basically valuing them at saying asset values are going to go down 30% and they're going to lose money or break even. And so I think it's an incredible opportunity in our space right now. We've had everything negative, more or less, thrown against us between seasonality, crude cannibalization, weaker refining margins, a tough macro tape that I think if you asked any one of us, we would expect rates to go up from here, not down.
I take James's point on the, what brought us to the product sector 10, 12 years ago was the whole refinery issue, and that was a long-going macro trend back then, and it's continuing to go, I think, at an extended rate because you're closing down all the, the non-modern fleets, the non-modern. Do we have a refinery on the East Coast that can get us anything? I don't think so. We have to get it from down south. I think what's happened is the Red Sea. The last 2 years, whether it's crude or products, they've been trading. If you look at it on a historical basis. On a quarterly basis, take out the daily volatility, it's been trading well above 20-year averages, and we've been putting out ships at that. Now, if the Red Sea comes off, I think you got 2 million barrels a day went through the Red Sea before, I think 4 now, I'm not sure if those numbers are exactly right. So you may correct down to below 20-year averages, but I don't think there's going to be this is not a free fall. If it's a drop, it's a slight drop. So I think, you have that overall demand again. You have, we talked about the increased 1.5 million barrels next year. I think between now and 2030 in the Atlantic is about 4.5 million barrels extra capacity coming on, and that has to go east. So that's the big macro. Then you have the Red Sea, which is applying to that, and then you have this, with the sanctions. The sanctions bring you to the Red Sea, and now you can't go to the Red Sea because of the Houthis. This is a double, triple whammy here for shipping. Now, the short term may fade out. I don't think it's going to. The war ended tomorrow in the Ukraine. Europe is not going to go back to taking gas, and I think they went from 45 to 15% of their energy from Russia, and that ain't going to change overnight. So we've got a good run here.
Can I challenge that though? Because if let's say that the war in Ukraine were to end, what is the real argument in not sourcing your energy from the cheapest source when you've seen the flexibility that the global shipping fleet can supply?
I can't see Europe going back to Putin and taking their energy from him again, and even if it's his successor. It's just not liable. He's not consistent. You're just hanging your noose again. Look what happened to Germany for doing that.
And what chips will
I
they
would
use?
like to add as well that there's real stickiness to certain trades as well, right? I mean, we've now been living in this world for 2 years, where of course a lot of new trading relationships have been established, and some really interesting two-way trades have emerged as well, and those are not going to necessarily overturned over, I guess, the cost of freight, which is a relatively small component of the overall cost of the product, really. So I like to think that Europe would be hesitant to go back to a full dependence on Russian products and oil. But more importantly, some of those trades are now just alive and kicking, and there's going to be stickiness to them.
I would argue that dependence is different from what's practical, but I get your point. Did you have a comment, James?
Well, I just think about what chips are they going to use? Are they going to use the 16 and 17-year-old tanker that's been serving Russia? So that's going to be the vessel that an oil major takes to carry the Russian product to Europe. So even if the product starts flowing, the ships themselves, we're probably not going to be, there's going to be a supply impact, is my point, that we've already been feeling in the market today, and we expect that to persist, because if you think about the vetting and the maintenance and the age of that ship, right, it would not meet the standards of the oil majors, as it currently is, but factor in the trading history and it owned by a Shell corporation. So we think that supply reduction is actually permanent.
Yeah. Because that was the next step in the argument, really. The developing shadow fleet that has been trading a lot in these sanctioned or gray trades, you can say. You do not think they will find their way back, but is that on the basis of an average market or a strong market or a weak market? Isn't shipping notoriously able to recycle old ships that presumably have been scrapped even back into service?
With IMO, it's a little bit different today with the new regulations coming in. And I think even if the shadow fleet doesn't automatically all go for scrapping in 2 months or through the year, I think the utilization rate, let's say that utilization rate's 80% on those ships. I'm just picking a number. And after this is over, they start being utilized more frequently, but I don't think they're going to I think it's going to be half of that rate. So a deadweight capacity of 10 million will act like 5. So even if they don't get scrapped, I think it's positive for shipping.
Any other comments on the shadow fleet, Russia?
On the shadow, I would add that the shadow fleet is vessels which were involved in some way or another with Russian trade. If we do consider them part of the shadow fleet, then we are talking about a huge number of vessels. We are talking about possibly over 1,000 vessels which were involved in such activities. If we then include also the Iranian vessels involved in the Iranian and Venezuelan trade. So then, of course, there are some which engage in both markets and are more properly maintained. But there is a big chunk, as the other panelists commented, which has been very poorly maintained, and it's going to find it very hard to come back to non-Russian business if sanctions on Russia are lifted.
Yeah, I agree. I think that's a very interesting dynamic. And the funny thing is, of the ships that actually use the Red Sea right now, a large proportion of them are these ships we've just discussed, which is also, I guess, interesting when considering the two different geopolitical scenarios and not grouping them together, I think. The order book has long been a case in shipping across sectors, and especially maybe in tankers. But if you look at the run rate ordering over the past few quarters, it's actually been the record. There's been a record ordering run at the yards, meaning that there apparently is a case for the new builds among investors, and people are willing to take that leap of faith. What do you think about that as things stand right now, Gernot, on the new building prices, and does that make sense? And if not, who is ordering?
I think there is a, if you look at fleet supply as a whole, we're looking at a very old fleet at the moment. The order book, you're right, we've seen it increase, but we're far from record highs of the order book. And at the same time, we have had a 2-year backlog of scrapping activity that has continued to really drive up the age demographic of the fleet. Yeah, the order book has grown somewhat, but the amount of tonnage that's older than 15 years is 5 times that order book. So I think there is a general shift towards an aging of the fleet. For us at Ardmore, our age distribution is between 2017 to 2013. We feel like that's kind of the Goldilocks zone, not too modern, not too old, and we don't really feel any pressure to rush into fleet modernization, and we can really kind of continue to evaluate opportunities in the cycle as it plays out.
Okay.
And I would add just a lot of the order book is LR2s. And if you're ordering a $75 or $76 million LR2 delivering in 27, 28, you're going to get the coating on it to order an LR2 for $2-3 million more, as opposed to having it traded as an Aframax vessel or be built as an Aframax vessel. But the Aframax dirty market is 12 to 14 million barrels a day. The LR2 clean market's 3.5 million barrels a day. So it is almost impossible to not have a portion of the current LR2 fleet continue to trade in the dirty market just to maintain that current fleet size. And similar to what Gernot said, is also in the Aframax segment, very, very old fleet. Through 300 vessels will be 20 years plus by the time those deliver. So I do think the order book's a little bit overstated as a result of that.
I can tell you what we're seeing. We took some of the cash we made on the containers and went into the tanker new buildings, and every time we went to the market, we had backing, we have contracts. What's interesting to me, I grew up on the trading side, so I can clearly say from 1 to 3 years, to me, period market is because the pain of the spot market. I went into my boss, said, listen, I'm going to lose $2 million on this cargo. If I take a ship for 2 years, I'll break even. And that's what propels the period market. However, when you do over 3, 5, and 7 year, which we're seeing and doing, that is actually the shorts, the oil majors and the major oil traders, the senior management taking a portfolio risk and saying, listen, in the teens for that decade, if we went spot the whole time, we'd be great. But the landscape's a bit different here, and our portfolio's got to go from 5% long-term coverage to 20%. And that's what you've been seeing out there. Every time this market comes off, you have charters sniffing to get into long-term deals because they don't see the steel. They want off-balance sheet steel, but they want control. And they're out there, believe me, this market still has legs, even if it's got a lot of volatility.
Okay, thank you. And you mentioned, or one of you, it slipped my mind who, but the deleveraging is a theme. And there's been a lot of debt being paid down, which is a headache for us from the bank side to an extent. But I guess it's good for you and keeping the cash costs low. But then again, there's always a question in shipping, what's the real value of leverage? And where is the perfect balance in that sense? So to the panelists, I can start with you, Gernot, on leverage. Where is the sweet spot? Where do you want to be? Is it deleveraging key?
I think the sweet spot for a shipping company, recognizing that every company might have slightly different approaches to it, but I think the sweet spot needs to be looked at across the cycle. And it's not something that you kind of just try to manage towards regardless of where the market is. So I think there's naturally times when you will deliberately lever up and increase your exposure. And of course, when the market gives you an opportunity to delever and delever decisively, that's something we also felt is prudent to do. So we can then, at the right time, again, increase leverage and continue to find that perfect balance on a through the cycle basis. For us, if we look at how we deployed capital over the last 4 quarters, it was basically in equal parts, deleveraging on one, and then reinvesting in the fleet and returning capital to shareholders, which we felt is a prudent and balanced approach given where we are at the moment in the market.
And so turning a bit over to you then James, on the capital distribution side and the dividends. There has been a rather limited part of cash flows headed out to shareholders so far on the dividend side. What's your thinking on that versus the rapid deleveraging that you've done? It's just been massive, over the past few years. Your priorities and thinking and rationalizing around that would be useful.
Sure. So as we came out of COVID, end of 2021, we had about $3.2 billion in debt. $2.2 billion of that was expensive lease financing at 300 to 500 bips. First thing we did was pay that off, start refinancing. To your previous question, I think optimal leverage for somebody like us is how can we maximize revolving capacity so that we have the flexibility to adjust leverage when we can. So that's one of the things we've done, and it also plays to your answer here on capital allocation because we spent a lot of time deleveraging, and last summer we stopped and paused and bought back a lot of stock when the share price went from 60 to 45, and then last fall resumed the debt repayment and the refinancing. And only recently have we really started, I think it was our last earnings call, highlighting now we can really return capital to shareholders because we've gotten debt down so low, we've got revolving capacity in place, and we're really excited about kind of the market as we look forward. At that point in time, we're trading 20 or 25% discount to net asset value. We think buybacks are more accretive than the dividend. And so that's where we have focused the majority of our return to shareholders. We have raised the dividend 4 times. We're at 40 cents per quarter, $1.60, so a little bit under a 3% yield. But given the choice, we think that it's more accretive to buy back stock, as well as because we've been selling vessels. So if you can sell a vessel at NAV and then go out and use those proceeds to buy back your stock at that 25% discount, then you're crystallizing that value.
Carlos, you've been also on the dividend side. What is your thinking around the same question, really?
Yeah, it's not too dissimilar from the answers that Gernot and James gave. We also have been rapidly deleveraging our balance sheet for the same reason, to acquire flexibility to then be able to be agile and make the most of opportunities that might arise in a different market environment. However, yeah, we have, as at the end of June, the ratio between our net financial position and fleet market value was at 9%. I expect it to have fallen further in Q3, given vessel values held firm and we continue generating substantial amounts of cash. We have started distributing more cash to our shareholders. We don't have a dividend policy. We are not as aggressive as some of our peers in terms of dividend distributions. We are also active on the buyback front. Out of the results of last year, combining buybacks and dividends, we distributed around 30% of profits. This year, our intention, of course it has to be formally approved by the board and the shareholders, would be to distribute 40% of profits as dividends and buybacks. And in terms of buybacks, we tend to be more aggressive when we see the discount widening too much. So yeah, that's it.
Isn't dividends, though, an easy leverage to, I guess, assist on the pricing? Because a lot of the problem here has been that there is a discount to NAV. And I'll leave that as an open question to you. How do you think, are investors longing for more returns in terms of dividends and would gratify that by increasing the share price, do you think?
I think so. I think that, our strategy, we have a long-term approach to this question, but it's not necessarily the one which is the favorite one by investors. And my impression is that companies which are more aggressive in their dividend distributions are better valued at a lower discount to NAV. And I think that seems to be quite an important criteria for especially US investors, I understand.
Yeah, but wouldn't that do a lot to accelerate potential accretive transactions, for example, Gernot? Isn't that an easy lever to pull in order to make use of your equity? Or are you simply saying there is no use of the equity? We're happy with it trading below NAV so we can buy back cheap ships.
I think we've been fairly consistent and just guided by our capital allocation policy, which has, led us to find that balanced approach between paying out a third dividends to our shareholders, finding ways to reinvest in the fleet, which is, could be modernization. We did a spread play earlier this year where we bought a 2017 and sold a 2010, but equally finding ways to actually upgrade our ships through upgrading fuel efficiency or cargo versatility, which then gives you a guaranteed payback no matter what happens in the market. And of course, reducing leverage, as we have discussed, as a part of it. And, we will continue to, find the appropriate balance between all those capital allocation avenues as we continue into the next chapter as well.
And at Navios, we have a modest dividend, but I agree with James and Carlos that some of our shareholders are happy that if we do buybacks, we've announced it. We had some metrics in place. Remember, we put this conglomerate together of 179 vessels. We were at leverage about 45. Our targets were 20 to 25 and 300 and something million cash. And before we got to that, we saw that we were on such, we thought, a smooth glide path down to the low 20s that we started the buyback program ahead of time. And I think a lot of our investors like the fact that it's not an immediate tax event, right? You can then pick your timing for your tax event in the quarter or the year on a buyback because you can then sell your stock later or hold it. And so I think we've got down to leverage because we believe that, again, I said it on the drive, sort of like Michael Jordan, let the game come to you. If there's some distress out there in another sector that's eventually doing poorly, you can step in and then you lever up when the purchase is right.
Okay, then as a final question, are you buyers of modern tonnage for cash today? If I had a ship and wanted to give it to you for the amount that Clarkson quotes an MR, a 5-year-old MR today, would you be buyers? If we go down the road, not in equity, in cash.
Well, I'll start because we've been selling ships, so.
But it's a 5-year-old, James.
Well, we just sold a 2019 built LR2. But I think in small quantities, sure. But if you're given the chance to sell a lot of ships, no, we're quite bullish. So a few here and there. I believe Carlos has sold some of their older ships and bought some more modern ones. I would say that I would much prefer buying a 5-year-old ship than ordering a new build because you've got a constructive time charter market, good supply demand setup. That asset's going to generate some strong cash.
Okay. I think we're out of time, so we'll end it there. Thank you so much to the panelists for joining.